right, let's do it again. We're in entrepreneurship today. Right now, we're going to talk about financial aspects of business. Okay, for those juniors in my class, this is what we're going to be discussing. This is a quick review for you guys. I know you always have questions, or can't remember what we talked about. So this is going to help you. Let's get the purple marker. I don't know if this is going to be too dark. It's too dark. We got to go lighter. Today, remember, like, subscribe to the page. Okay, today we're talking about the key concepts and financial aspect of business are going to be capital, risk, and entrepreneurship. Exactly what that shows. Money is capital. We got to have the capital to make the business to work. If you don't have the money, the business isn't work. Money does not grow on trees. That is an old saying. It is so true. I wish I had the money. I'd just be pulling off the trees in my backyard. I could do so much if I had that. Not everybody has it. You got to work. You got to earn it. You got to find a way to get that capital so you can make that project work. Risk. Business has risk. So right now we're going to come over here. And we got to understand risk is important. It plays a big factor into what happens. Understand risk. Entrepreneurship, as an entrepreneur, you got to be innovative. You got to have knowledge. You got to have drive. You got to be able to understand the tolerance that risk is going to play a factor. And you got to be a leader. Those are the key things understanding when we're talking about this topic today. So right here, capital, risk, and entrepreneurship, key factors that we're going to be discussing throughout this chapter. Right now, we're going to hit capital. Let's talk about capital. Why is it so important? What does it mean? Well, it's right there. It's the financing that we need to make our brilliant market plan right here come to life. If you don't have the money, you got to find a way to get it, and financing is the way to get it. You look over here, money. Look at this gentleman over here. He's holding a dollar bill over here, right now. Money, the owner invests in the business. That's the capital that he invests, that money can turn around and do something. Okay, what does that do? It buys buildings, it buys machinery, it buys the equipment needed to make it grow. Capital is so important. Capital is a means of monetary funds invested in a project. Right there. Let's underline that because that's important. Okay. Who determines how much money we need? It's a lot of times in bigger companies, they still need financing, they need capital. It's your financial managers. They're the ones that are going to determine how much money you need. Do we have enough of our own personal capital to make this project successful, or do we need to get outside capital? They're the ones that are going to go in and find out how much discretionary funds are needed to make that happen. If you're an entrepreneur, you got a small business, that is your responsibility to determine, do you have the funds to make it possible or not? And that's where you have to go through and figure out what you need to do. So types of capital, you got equity capital, money raised from within the company or sell part of the company. So when we say sell, what do we mean? We mean stocks. So one is we either have the money, our own money, sit in our own bank account to do it. If you're a large company or you're an entrepreneur, small company, you got to have the money flow. If you don't, you got to sell part of the ownership. And what does that ownership look like? It's like a piece of pie. Look at these over here. These three people fighting over a piece of pie. Right here. When you initially start, you have the whole pie yourself. That means you have the whole control. That is the big advantage, is that you have control when you have complete ownership. When you start selling equity of it to get financing, that means you lose a portion of that pie. That right here, this guy right here with the fork right here, the dark blue one, you just lost a portion when he gave you $1 million to help fund your project. That is one thing you understand. The advantage of when you do so, and he's buying stocks, he's assuming risk and understands the risk, and you don't have to repay that money or any interest to him, because why? He gets ownership into it. That's the disadvantage that you gain. You got to understand that. If you're going to allow equity capital into your business, you're going to lose ownership rights, and that's a disadvantage because now you have a co-owner, someone that has input into and control of what happens at business. Now, granted, that's a small piece of pie, so you still got major control. But now when you sell this other portion over here, this light blue, you put the two together. Is it more than red? No, at this point, it's still not more than red. But it has more control into what happens. And as you lose more equity of your company and you sell it off, you lose control, and then the shareholders, the stockholders are looking for certain things to happen so they can gain profits, they can gain dividends, the stock value goes up, and they can make money. So, all right, sources include raising money, personal savings, big thing, partners, they gain equity rights into it, shareholders, they gain rights into it, shareholders. Those are the key things to understand. Okay, let's head on to the next slide. Try to make it under 10 minutes or less. All right, types of capital continue. You got debit capital. Now, some people are confused. What's the difference between two? I owe someone some money to somebody. No, remember when we talked about equity capital, we said we don't have to pay them back. Okay, right here, I forgot to highlight that. Let's hit that up real quick. Don't worry, you don't have to repay. Okay, you just now have a co-owner. All right, those are highlighted for you now. Okay, now let's go to debit capital. Debit capital means what? You raise money, you borrow. You're borrowing the money. That's what debt means. You're borrowing. That means you're taking a loan out. You're selling a bond. You're borrowing from family or friends of some sort. I put bond there. Why? Because the bond has to be repaid it by a certain time period. Large companies sell bonds as a debit source of capital to gain money instead of selling stock. It's a different type, but it still has to be repaid versus stock doesn't. So we're going to keep it that way because stocks, they give it dividends, but bonds have to pay. Stocks always don't have to. So what's the advantages of doing a debt capital? Borrowing money can raise credit standing. That's great for a small business because if you need money and you need to build up credit so you can get more funds, so you can grow your business, so you can go to the next level, you need the higher credit score, so you got to borrow money to move up slowly. But you do have to pay interest. Advantage of that is it's tax deductible. So we're going to underline those two benefits right here. Tax deductible and increases. Well, it says raise, but raise, increase, same thing. Raise your credit standing. That's the most important thing. Disadvantage, what can happen? The bank can make you go into bankruptcy. If you don't pay your debt and you don't pay it timely, you can be forced into bankruptcy. Even though right around the corner you can make it, they can determine when bankruptcy happens. So where your sources come from? Banks, credit unions, friends, relatives, previous business owners. And I put up their bonds for larger companies. Why? Because a lot of times they don't go to banks. They sell bonds to create capital. That's a form of debt. Let's go to the next slide. Last slide we're going to hit up right now. We should be done about 10 minutes. Capital source of banks. All right, so you got to understand banks offer a business of wide variety of loans and services. Granted, like I said, large companies don't use them too much, but your small businesses, medium-sized businesses use banks for funding, especially depending on the type of project they're trying to get accomplished. They offer large services, and so that's why there's so many different sources out there. Now, what's required to get a loan from the bank? You got to meet these 6 criteria pretty much that they're going to be evaluated for potential borrower. And I put this nice little diagram right here for you guys to help you understand. Credit score. Now, 750, maybe not, but that's a good credit score. They're going to look at your credit score. Depending on the type of business you run, you can have a business credit score, you can be an entrepreneur, they're going to use a personal credit score, all depending on what's going on. You got to build up that credit score eventually for your business. That's what they're going to look for. Collateral. They're going to want collateral. All right. What does that mean? The collateral has to be something that you need to exchange. Cash flow. That's going to be your capital. They're looking for something and that you can't put down. They want to see you invest. They want you to take some personal risk. That's the difference. So capital, collateral, capability. All right. That goes to your credit score right there. Your history, your experience, what do you know about the industry? What do you know about the business? I tried to get into the trucking. I was in the trucking industry, wanted to buy my own truck. First thing I look is my credit score. They said, "Oh, you got a decent credit score." I said, "Okay, what are your capabilities, your characteristics?" I've been driving a truck. I know the industry. I have the I have a distributor I know personally. I can get contracts. I get work. I understand the risk factor of it. I've been driving. Then they looked at what cloud they have, and that was my problem. I didn't have the cash flow to back it up enough that they wanted. They wanted a high cash flow that I couldn't get me, and that's what held me back. You got to have that cash flow. Okay. Last one is coverage and circumstance. That's the last two part two. That's you got to understand the insurance coverage. When I, like I said, when I was going to go in the truck industry, I had to know what coverage I needed. I had to have a $5 million policy so I could haul gas, and so I needed to be able to put the money up to cover that. Just for one truck, it was going to be about $1,500 a month just for insurance for that one vehicle. It's $1,500 just to cover, so I have a $5 million policy for an incident. General business plan. That is some of the most important thing. Banks want to know what your plan is, what your goals are, when you're gonna be able to get profitable, when you're not just gonna break even, when's your break even point, when's your profitable point, how long does it take you to reach your goal, what's your 1 year, 18 months, 5 year plan. That's what they want to know. They want to know how fast you can pay them off, because at the same time, business loans are not 30-year loans like home loans. They're more short-term, 5-10 year, depending on the amount that you're borrowing. That's it. We're done. We're talking about capital right now. If you have any questions, comment below, like it, subscribe, share with your friends that are taking business class. Y'all have a good day.